0.5% defect rate, it's enough to kill people, right?
Yeah.
So you need very robust testing before you send the chip out for sale. That is where the testing and packaging industry comes in. They have a lot of old franchise IP. And the 8,000 pound gorilla here is Disney. Okay, Disney acquired Fox in I think 2017, if I'm not wrong, right? If Netflix wants to make the Last Airbender, they want to make One Piece, they need to rent it from Shueisha, Japan, right? Netflix cannot do that, Comcast cannot do that, NBC, HBO cannot do that. Only Disney can do that. This is the epitome of wonderful business. Think about 30 years later, right? Everyone is going to be using e-commerce already. Okay, so Shopee has already created the foundation for that future oligopoly.
Hey everyone, welcome back to the channel. Today we are hanging out with my friend Aaron. He's an ex-equity analyst and a fund manager. So you might also know him from his Substack called valueinvesting.substack.com. We're going to be catching up and chatting about all sorts of interesting stuff. But before we dive in, if you're new here and enjoy this kind of podcast episodes, remember to tap the like button, okay, so you never miss another session. So without further ado, let's give a warm welcome to Aaron. Hi, Aaron.
Hi, James. How are you doing?
Hi. Yes, good. How about you?
I'm good. Very nice to see you again. I've known James for 10 years.
10 years.
Has
Yeah.
it been 10
It's
years?
been a long
I think
time.
so, right? Yeah.
Yeah, I think so too. Yeah, I
So
haven't been
very
here
glad to see.
recently.
Yeah, very glad to see James start his Invest Kaki podcast, right?
Yeah.
Something that
Thanks.
we yeah.
Yeah. Okay. So thanks for joining us today. Right. To start off, maybe we do some level of introduction first. I saw that other than your Substack, right, you also started your own YouTube channel. Can you give us a brief overview of both your Substack and your YouTube channel? What you have been working on recently?
Right. So I've been working on my Substack, which is a value investing newsletter, for the past roughly 3 years. And if you know me, you will know that I'm a die-hard value investor. I really believe what Warren Buffett says. Of course, if you want the full details, you can go to my newsletter. But that's my introduction, right? And for those of you who are not familiar with what value investing is, it's basically just treating listed companies as private businesses, right? So you are really looking at the you're not trading pieces of paper. You are really like acquiring pieces of businesses the way you acquire private business. So of course we can talk more about what value investing means later on. But with regard to your second question, I started a podcast recently called Economy Rise, where we are basically trying to break down complex economic jargon for the layman, because most people have some sort of personal connection with how the economy is performing, right? And unfortunately, a lot of this is really in the sphere of the economists. Like, it's very complex, it's very difficult to understand, and of course most people can if they had the time to try, but most people don't, right? As evidenced by the news flow and everything, or social media. So what we're trying to do is really just try and help people be a bit less angry, right? By presenting the truth, because most of the time, it's not about evil, like the policymakers are doing something bad. It really is about things being way more complicated than most people can understand, or at least not something you can fit into a bite-size, feed or something. So we are really trying to break it down and bring the truth closer to people when it comes to economic matters.
Oh, that's quite interesting because I noticed you mentioned the word angry, less angry. So I suppose you think that people would always read the news, they will just read the headlines, and they will feel that, hey, why are they making such wrong policies and that kind of thing. So yeah, I think your YouTube channel is worth checking out. So later on, in the YouTube channel, I will put both of your links, your Substack and your YouTube channel, for our readers to check out later. Okay, in the description box.
Thank you.
Yeah. Okay. So next question, right? Before we talk about value investing and all that, right? Can we touch on your very first investment? So I noticed that you have come a long way, right? From being an equity analyst, fund manager, and now starting your own YouTube channel. But let's take it to the very first investment, right? What initially sparked your interest in the stock market, and what did you learn from that experience?
Okay, it will not be technically my first investment because I don't really recall exactly what is the first thing I bought, right? But I can
Yeah.
tell you what I remember as a material, concern. It was
Mm,
Apple. And the
mm,
context here is that it was around, I think, 2014 at the time, because uh, those of you who are following the tech space, right, will know that uh, Apple at the time is not the Apple that we know today, right? At the
mm,
time, the news headline was that they had already saturated China as a market, right? And then there was nowhere else to grow because obviously they had already saturated the US, and at the time
mm,
India was not really a viable place for high ticket, flagship phones, and
mm,
so there was no more growth, right? And that was why it was trading at about 14 times PE roughly.
mm,
So even though at the time I wasn't as able to do analysis as I am today, I basically so I was an Apple fan, right? And I've been doing like really more technical Apple stuff since I was younger,
mm,
and you know even at a very basic level, I understood that they had roughly one third of the market cap in cash, net cash, right?
mm,
That was before they started going into their taking a lot of debt to do share repurchases. It was even before Buffett started to buy, right? Buffett only bought in about first quarter 2016. And I'm
mm,
not trying to say I'm better than Buffett, right? I'm just saying that even as a technocrat, right, a technologist,
mm,
if you understood the business well, which is what value investing ultimately is, you
mm,
could have recognized that it was a bit absurd for Apple to be trading at roughly single digit X cash PEs, right? Of
mm,
course, nobody could have predicted the low interest rate regime, which the Fed only started in 2016. The fact
mm,
that Buffett also got in around 2016,
mm,
and the later on developments, which was the M1 chips with the laptops, as well as the AI stuff, right, which only just came out. So nobody
mm,
could have predicted that in 2014. But even by virtue of their basic business at the time, you could have seen that Apple was already trading at like single digit X cash PE, and that
mm.
was just my entire my entire argument.
Yeah, and you took a stake back then.
uh, yeah, I did I did yeah.
That's very nice. Actually, talking about Apple, right? I initially wanted to also invest in Apple because I saw the business, I was analyzing it, and I even see that a lot of people around me are using Apple phones, but I just didn't take a stake because I believe the headline news too much that there's saturation and things like that. I
Right,
didn't recall that they go into the services business. Yeah,
right, right,
that's
right.
very
Yeah,
nice. Yeah, yeah, yeah.
no, in
Thanks
fact,
for
right,
sharing. Hmm?
if you go to my newsletter, you will find an article that explains why I think Buffett bought Apple. Right,
Mhm,
it 2016, when the same arguments were true, right?
mhm,
Right, all the things haven't happened yet, and you will actually realize that Buffett bought it because it looked like Coca-Cola. Okay, it
mhm,
was a single product company, one with a
mhm,
huge moat.
mhm,
uh, I think to this day, most of its revenue, okay, not maybe not now, but even as recently as 2019, most of its revenues were like iPhone. That's it.
mhm,
And it had a very, very high ROE, right? By virtue of the fact that it was doing a lot of share repurchases, which
mhm,
again is what uh, Buffett encouraged KO to do,
mhm,
Coca-Cola to do in the 90s. And
mhm,
it was very high free cash flow with a great international business. So you really see the parallels there lah. If you really want me to go
mhm.
into it, I could yeah.
Okay, maybe just check out your Substack
Right,
with the
right,
link
right,
down
right,
below.
right,
Okay,
right, right.
thanks for sharing on that. So next question, let's talk about value investing, right? Some principles. Can you describe more of like your investment philosophy when it comes to value investing and the key principles that guide your how you look at businesses as a whole? Yeah.
Right. So I think a lot of people have this misconception that value investing is about cigar butt investing, right? Which is that you
Mm,
invest in low multiple stocks like Benjamin Graham, who is the mentor of Warren Buffett. And I think this is not the correct way to think about value investing, because if you look at how a lot of non-stock market investors are described as value investors by the value investing community, it has nothing to do with stocks even, right? The main philosophy, for instance, let's talk about, what's his name? Teledyne's founder, Henry Singleton, right? So if you read the book, the Outsider CEOs, right, by William Thorndike, it's a great book. I really recommend it. The first person who is discussed about alongside Warren Buffett is William Thorndike, right? Others include people like Catherine Graham of the Washington Post, which a lot of value investors will be familiar with, a great friend of Buffett, as well as more recently John Malone, who basically is still around today. He's managing Liberty. So if you've been hearing all the F1 news, right? Yeah, he owns F1, right? So
Okay.
I'm purposely trying to be different here in how I describe it, because I want to emphasize how value investing as a philosophy is not about stocks per se. Of course, we all know that it's about long-term investing, right? Sorry, give me a sec. Let me drink some water.
Yeah, no problem.
It's ultimately about investing in stocks and treating them as private businesses, right? Rather than pieces of paper. So this is what you hear a lot of people say about. But it actually goes much deeper than that. Ultimately, I think it's the overlap between ROIC, opportunity cost, as well as risk. So let me break it down very quickly. ROIC means that it's about yield, right? It's about, in a business's case, earnings yield. So it's less about capital appreciation. You see the difference? Because when the stock goes up, most people are very happy about it. But if you think about it in terms of earnings yield, when the stock goes up, it's more expensive, right? You're getting a lower yield, just like bonds, right? So that is one. Opportunity cost is really about something that ROIC doesn't really cover. So it's the ROIC of another stock, right? Or another business. And uncertainty is recognizing that the world is very uncertain, right? Like, Buffett himself said that I couldn't tell you what is going to go on in the stock market tomorrow, much less next year or 5 years from now, right? So if you are someone who reads the news or doesn't live under a rock, you will know that the past 5 years has been total chaos in the world, right? And it definitely affects your stock price, correct? So uncertainty means that you need to manage risk. You need to understand what is the downside, right? And the way I would wrap it up is by saying that, look at Soros' quote. Okay, he says that it's not about whether you are right or wrong about the stock, right? Most people tend to think, are you right or wrong? Will the stock go up or down, right? It is really about how much you make when you're right and how much you lose when you're wrong. So he's just recognizing that the world is uncertain. You cannot predict it. Howard Marks also says this. What is more important is risk reward asymmetry. You need to know, in the event it goes, you are right, how much does it make? In the event you lose, you are wrong, how much does it lose? You need to look both sides, just like before you cross the road, right? And also, Ben Graham has a saying, the definition of an investment operation is one which promises safety of principal and an adequate return. So keep in mind, when he says safety of principal and adequate return, what does this sound like? It sounds like a bond, right? He's basically saying treat the stock as a very high yield, higher risk, higher return bond. But importantly, don't treat stocks like the way most people treat stocks, which is capital appreciation. You need to really think about it in terms of like interest rate, as well as the potential that you might lose your capital, your principal, and cannot redeem it because, like in the bonds case, the company maybe go bankrupt, right? Then you cannot pay you back. You got to think about stocks that way as well.
Oh, very nice take on value investing, like focusing more on minimizing the downside, lah. Right. Okay.
Yes,
Yeah. Thanks
I think it's
for
really
that.
more about
Mm,
asymmetric risk reward lah.
the reward to risk ratio, lah. Okay,
Yes.
sure. And next question that I have. Okay, so you cover a lot of industry primers inside your Substack, such as like semiconductors, the big gaming, and the oil and gas sectors. Can you just pick one of it and that you are most interested in and share more about the sector itself? Yeah.
Okay, let's just do semiconductors because I think most people will be interested in that, right?
Yeah.
So, if you know semiconductor, this is a free article on my newsletter. You can go and read it out.
Mm,
Basically, there are five subsectors in the global semiconductor supply chain. So the five are um, ISA, right? Instruction set architecture. So this is where your AMDs, your Intel x86, right? They are here. Are ISC. Then you have your design, which is the software design of the chip. So this is
mm,
where you get things like the Apple M1, the AMD design, or like Qualcomm, right? Snapdragon.
mm,
Okay, it's the
mm,
software design, or even Nvidia, correct?
mm.
They do
Yeah.
CUDA, which is the platform for how they write the chips, but they are not doing the actual chips themselves, the physical chips.
Mm,
It's just software.
mm,
The third subsector would be fabrication. So this is where the hardware stage comes in. So this is
mm,
where your TSMCs, your Intels, your Samsungs, right? They come in and
mm,
actually create the chips. And to be clear, it's not just the leading edge chips; it's also the trailing edge chips, right? The 40 nanometer and above chips. Then
mm,
you have the fourth one, which is equipment. So equipment is your ASML, right? Which is your EUVs and also the lower level, lithography, your DUV, right?
mm,
So this
mm,
is not fabrication because fabrication is the whole, giant compound in TSMC, right? EUV
mm,
only does, ASML only does the EUV machine, right?
mm. The machine itself. Yeah.
Right. Or as well as applied materials, Lam research,
Mm,
right? All these
mm,
are equipment. And then
mm,
finally you get to testing and packaging, which is
mm,
so if you buy a chip on Intel, an Intel chip from your your shop nearby, what you are holding when you take it out of the box is actually the package. The actual
mm,
chip, right, that you always see people hold in the news shows, right, is actually not that, it's actually a very much smaller part inside the package.
mm.
Because the chip itself does all the, the brain power, right, of the
Yeah.
chip. But
Yeah.
you need to get power, like electricity to the chip. You need to release heat, right? You need to figure out a lot of ancillary stuff that is not about brain power for the chip to get it to
Mm,
work. All that is
mm,
packaged on the packaging. That's why when you take it
mm,
out, what you take out of the box, that is the packaging, right?
mm,
And also the testing. So after you make the chip, chips have about roughly, so the leading edge chips right now have about 5 billion transistors, right? And your
mm.
chip is this small,
Yeah.
right? And the average acceptable defect rate is roughly, I think, 0.5%, right?
Wow.
So you take 5 billion, you multiply it by 0.5%, that's still in the order of like, I don't know, 100 million or something, right?
Yeah.
And you cannot have, you can probably have one transistor fail, but if you are doing something very mission critical, like driving a car where people can die, right? Or
Mm.
launching a rocket into space, you imagine if 100 million chips fail, transistors fail, right? Even though that is just a
And if you have enjoyed this video thus far, I will greatly appreciate it if you can help me to smash that like button, subscribe to my channel, and ring the bell so you get notified every time I release another stock analysis video.
0.5% defect rate, it's enough to kill people, right? So
Yeah.
you need very robust testing before you send the chip out for sale. That is
Mm.
where the testing and packaging industry comes in. So just
Mm.
since I'm living in KL, right, Malaysia,
Mm. Mm.
just a huge shout out to Penang. They do about roughly, I think, 13% or 12% of global semiconductor testing, right? And to
Mm.
be clear, it's really on the trailing edge, not the leading edge. But nobody would have expected small little island Penang to do over 10% of the world's supply, lah.
Yeah. I think, I
Right?
mean, the cost matter as well, lah.
The
If
cost, yeah,
if
yeah,
they
of
would,
of course, right, of course, definitely, right? Definitely.
yeah.
But I mean, if you want to talk about cost alone, you could have been doing it in other low cost areas as well,
It's
right?
just
So for
nice, yeah, fusion of everything.
I mean, maybe in a future episode we can talk about it. There's a whole
Yeah,
backstory.
the whole story about it. Okay,
Yeah, yeah,
thanks
yeah.
for sharing. Anything else to share about the semiconductor industry, like
I mean,
the
as you
companies involved or things like that?
okay, like I think maybe people here might be interested to know about the trade war between US and China, right?
Or maybe you
So
can share a bit. Yeah.
yeah, I mean, if you want to know why all the sanctions and why China is having difficulty building the leading edge chips, right? It's really because there is only 3 leading edge foundries in the world. So it's TSMC, Samsung, as well as Intel, right? And all 3 are kind of out of reach from China, right? Even as a nation state concern. So, there's just not a lot of ability for them to create this, right? And then also the EUV machines, which are necessary for creating leading edge chips, they are made by ASML, which is again in the Netherlands, right? So again, they have inability to procure. Because keep in mind, EUV machines, I mean, have you seen a picture of EUV machine? It's
Yeah,
like
I
the
see
size
that
of a
before.
whole room, right? And
Yeah,
not just a small room, like a master bedroom, right?
yeah.
So if you just buy the EUV machine, is one thing, right? You need to maintain it as well. If you don't maintain it, it's just a big paperweight, correct? So the only
Oh,
people who can or who has a decade of experience, doing maintenance of EUV machines is ASML's engineers, and they are located in the Netherlands. Of course, they can fly over, but you can imagine it's difficult for them as well, lah. So that is the main reason. And of course, I know China has done or rather, what is it? Huawei, right? Has done
yeah,
the 5 nanometer chips recently,
yeah.
right? So the 5 nanometer chips are made with older technology called DUV, right? DUV is just the precursor to EUV, right? That was quite popular, I think, I don't know, 5, 6 years ago, right? And what you can do is you can do something called multi-patterning. Okay, multi-patterning means instead of okay, let's say if you were to use an EUV chip to print a 5 nanometer chip, you can just make one pass through, right? Because your EUV ray is 13 nanometers thick. Okay, and whereas DUV relies on the older technology, which is regular lithography, and the wavelength for regular lithography is 193 nanometers. Okay, so imagine trying to print a 5 nanometer design using 193 nanometer. That's literally a factor of, I don't know, 15, right? More than 15, in fact, it's like 30, right? So what you got to do, right, is that you got to print multiple times. Okay, you got to put a mask on, print it. Oh, sorry, you got to put several masks on, right, to get the 5 nanometer line, right? Then use the UV, and then because it's a light, right, it will only shine through the part where you allow it to shine. Obviously, if it's blocked by the light is blocked, you cannot, right? So if you do that, we call that multi-patterning. But as you can imagine, right, it's much slower, right, than you just doing one time with EUV. And EUV is and in a foundry at TSMC, right? At the end of the day, it's an assembly line. It's a factory. The economics of TSMC, even though it is using space age technology, is still ultimately the same as your factory churning out widgets. And the way to drive down the economies of scale in this very commoditized business, right, is to basically do more of it, right? So if you are slower by someone else by a factor of 10, obviously your cost is not going to be great. So what Huawei did, let's be clear, we have to really give the engineers prop for using a 193 nanometer wavelength light to do a 5 nanometer design. That is just amazing, right? I mean, that is just mind blowing. You just think about the ratio, so already, like 30 times.
Yeah.
But at the same time, you can't do it very cost effectively, right? EUV is already 13 nanometer. You are trying to create a 5 nanometer design. It's already multi-patterning, right? Now you are trying to use DUV, which is a 193 nanometer wavelength light, to create a 5 nanometer design. Your unit cost is going to skyrocket. Okay, and of course, it is definitely a strategically important sector for the China, which is why they might be willing to do that. But you cannot possibly match the cost uh, of creating leading edge chips using a DUV machine versus an EUV machine.
Thanks for that. And the next question, or rather, now let's hop over to the individual companies itself. Lah. So inside your Substack, I also see that you cover quite a few companies like Citrus, XM, Steel Limited, Tesla, Disney, Floor and Deco, etc. Can
Right.
you just maybe pick and share two companies that you have high conviction in right now, and what makes you confident in their future performance?
Okay, cool. So I just want to clarify to the audience that this is not about investment advice, right? What I say is answering your question, which is high conviction business, not
Mm,
high convictions valuation. Okay,
mm,
because a
yeah.
good business, as you know, tend to be very popular. Everyone crowd into it and beat the share price up. So just
Mm,
because a business has a moat or is very good, right, doesn't mean there is a. I mean, this is value investing, right? Doesn't mean it's a great
yeah,
stock.
yeah.
So a good example of this would be Meta, like, it's great business, but
Mm,
I'm sure very few people would think it's a great start right now. Okay, so for so specifically, you mentioned two that I think which are great businesses.
mm,
I think let me see. Okay, I think we'll talk about say Meta and Disney. Okay, so
mm,
Disney, right? Disney doesn't really need any introduction. It's great.
mm,
It's a global business. And
mm,
in the media business, what you need to know is that the business model of media is very hit driven or hit ratio, you may have heard, right? Hit ratio
mm,
means it's about being right or wrong, not how much you make when you're right and how much you lose when you're wrong,
yeah,
right? It's about the number of times you are right or succeed. So this is
mm,
the way most people think about success, right? And if you think about successful shows, right, they tend to be quite uncertain. Sometimes, of course, you get your Avengers and stuff which are almost guaranteed to succeed,
mm,
but you sometimes get something like Squid Game, which is like super low budget and suddenly just became a hit. Okay,
mm,
I just based on an analyst's point of view, right, I'm pretty sure that the organizers or the producer of Squid Game never expected it to become the hit that it did, right?
mm,
So my point is that there's a lot of luck or randomness involved in which show becomes successful. And so what the big companies in the media space have adapted to do is one, they have a very VC kind of approach to producing shows. So if you think about, VCs, they invest in 1,000 different businesses, hoping that just one of them will make up all the losses, right?
mm, mm,
In When you're creating new shows in the media business, it's the same. There's just too much randomness in which show is going to actually be successful. So what you end up doing is you create 1,000 different shows, right, for new shows, and then you just throw them out into the wild and hope one very successful show makes up all the losses of the others. Okay,
mm,
but the more reliable way of hacking the system is that you deliberately try to create a hit show from the start. So rather than just relying on randomness to help you, and this is what
mm,
we call by creating hit content. What do I what how It's very simple. You just maximize the probability that it will become a hit show. How you do that? Hire the most famous celebrities, right? Create, and I think the most important one is you create a show based on a previously successful franchise. So you see
mm,
Avengers, they're really milking it, right? You
yeah,
make Iron Man, then the Hulk, then Black Widow, then
mm,
Avengers 1, then Avengers 2, then Avengers 3, then Eternal, right?
yeah,
Why do
I
they do
agree.
that? And to the point where after 12 years, we already like got fatigue, superhero fatigue, right?
Yeah,
But why do they still continue to do that? There's a reason for it. It's because it's very reliable. They know, right? You create this show, it's going to get like this X amount of revenue, right? And even though at this point it's already a tired franchise and the growth is not there, right? It's cash flow, right? or not? You're going to create this $1 billion revenue. You know, like, there's a 90% chance it will be that. But of course, creating hit shows is also very expensive. You got to hire Scarlett Johansson, you got to hire
mm,
Chris Hansen, right? These guys,
mm,
they come with their price tag.
mm,
So there is a trade-off between cost as well as benefit. Okay.
mm, mm,
But of course, you also reduce risk lah. So in a
mm,
way, this is also like value investing, right? Remember what I was saying? Value investing is about ROIC, it's about opportunity
mm,
cost, it's about asymmetric risk reward, right? When
mm,
you're creating a show, you need to figure out what's the ROIC of it. So do I create a new show which is cheap but can earn a lot?
mm,
But the new show has a lot of higher risk, right? And there's opportunity cost because once I create a new show, the money is gone. I cannot create another show.
mm,
Or do I take the same three principles and create a hit content show, which is much more expensive but lower risk? I'm guaranteed to get this X amount of revenue. So this is also value investing. Notice how there's nothing to do with stocks, right?
mm, mm,
So Disney in particular has one thing. Okay, before I go there, you may have noticed that Netflix recently has been quite active, right?
Mm.
They created some pretty hit content. I don't know if you watch them. Arcane, right? They've created The Last Airbender. You can see that they're going into the
Physical
live action.
100.
Sorry.
I watched Physical 100. Yeah.
Yeah. Oh, okay, I don't really know that, but I know even most people will know like Stranger Things, right? Queen's
Yeah, yeah,
Gambit, right?
yeah.
There are a lot of really hit shows that Netflix created to their credit.
Correct. Yeah.
But you notice one thing they don't have, they don't have existing franchises to build on. It's all new
Mm.
content, so they need to
Mm.
really like take the risk just because they have no choice, right?
Mm.
What the older guys, legacy media guys have, they have a lot of old franchise IP. And the 8,000 pound gorilla here is Disney. Okay, Disney acquired Fox in I think 2017, if I'm not wrong, right? Fox owns all the hit like Titanic. Is it on? I don't think if I don't know if they own Titanic. They own a whole bunch of other stuff, lah. Okay.
Mm.
Then they also own, obviously they own Disney, right? They
Mm.
own all the Mickey Mouse. Okay, now no more lah, no Mickey Mouse, but they own like Kim Possible, right? All these kind of like really hit content, right?
Mm.
And um that means they don't need to rent it from other people. Okay, in the industry, renting the IP is called syndication, right? And they don't have to rent it. So like if Netflix wants to make the Last Airbender, they want to make One Piece, they need to rent it from Shueisha Japan, right? They need to syndicate it.
Mm.
And as you can imagine, Shueisha is like a monopoly over the One Piece franchise, right?
Mm.
And Netflix really has to pay out the nose just to get it. It's a highly capital intensive business. So Disney really has all the IP, every American IP you can dream of. They have it, They literally
Mm.
have Marvel, right? They have Star Wars. I tell you,
Mm.
what Bob Iger did over the past decade, right? It's just nothing short of phenomenal. They consolidated so many what we call general entertainment IP, right? I think for what most laymen to showbiz will be familiar with, right? They really only don't have a few hit content general entertainment space, such as Game of Thrones, right? That's owned by HBO. Or yeah, to be fair, they don't have quite a lot, but the ones that really matter to the people, right? Like in terms of it will draw everybody, no matter who you identify as, right?
Mm.
Um, really, Disney has almost all of them. So that allows them to really have this like 8,000 pound gorilla status in the industry. Netflix, keep in
Mm.
mind, they have no ability to do it. So they either can take the risk and create hit content like Queen's Gambit, Stranger Things, right? Or they have to rent it like One Piece, Last Airbender for other people, which means it's higher cost, right? It's a no-win scenario. Disney, they already depreciated all this IP like decades ago, and they just need to make a show out of it. And it's quite
Mm.
reliable, A Marvel acquired by for 4 billion. I think
Mm.
latest they've already made over like 100 billion in revenue or something, right?
Mm.
So that is the media side of Disney. But don't forget, Disney also has Disneyland, right?
Mm. Yeah.
So media ultimately is a commoditized industry, okay? Which means that it really boils down to the consumer, right? In let's say in most other commodities industry like insurance or even in retail,
Mm.
or even on social media, right? It's about price, right? Like how much you pay. That's how the customer decides the commoditization.
Mm.
In showbiz, the commoditization is about quality of the show. Okay, ultimately the customer decides what they want to watch, right?
Mm.
And when you want to watch, right, it's not just you watching. It's about whether you can talk about it with your friends, right? So
Mm.
everyone has to congregate into one hit show at the expense of everybody else. That's why the VC industry kind of phenomenon exists. So
Mm.
it's very commoditized because the customer has all the power in this framing, right? The companies, unless you own the show, you don't have any power to decide who the customer will watch, right? Which
Mm.
show the customer will watch. So highly commoditized, and it becomes very capital. It's very capital intensive to build a show, right? Like most
Yeah.
shows cost like I don't know, 100 million or something, right?
Mm.
The big
Mm.
hit shows, and ultimately you want to spread the fixed cost of the production over as many people as watchers as possible. So that's where you get the theater industry. That's where you get the streaming, right?
mm,
And what Disney can uniquely do with Disneyland, which all the other media titans cannot, is
yeah.
spread the fixed cost of production over Disneyland itself. So what do I mean by that? Think about the Pirates of Caribbean rides in Disneyland, right? They spent this 100 million to create a Pirates of Caribbean franchise. They took a huge risk doing it, and it's successful, right? Now they can take the cost and spread it by making a ride in Disneyland, right? And
Yeah.
this was already factored into the initial risk of the production, right? Netflix, when you try to create something new like Queen's Gambit, all the risk is held by the media, the producer in the producer segment, because that's the only business they have, right? When Disney creates Pirates of the Caribbean the first time, they don't know it's going to be successful or not, right? It's a new show. So what they do is they will say, okay, we will spread the risk of the cost by creating a ride in Pirates of the Caribbean. That ride can generate revenue and make a recoup. Even if the new show doesn't succeed, we can still try and break even on it. You know what I mean? Right? Netflix cannot do that. Comcast cannot do that. NBC, HBO cannot do that. Only Disney can do that. This is the epitome of wonderful business. Right? Almost like all the shebang that you talk about in value investing. Right? I tell you,
Yeah.
it's just really unbelievable what a strong long-term enduring advantage it has. The reason why Disney is not doing well now as a business is
Yeah.
because it is making a very painful transition from the old cable distribution channel to streaming, right? So we all know Netflix has won the streaming wars. It's already there. And what Netflix has on this front, right, is that the advantage it has over everybody else in the industry is that Netflix is already okay. It started in streaming, right? It didn't have a cable business to transition from. Okay, so Netflix, it got lucky over the past 10 years to beat everybody else like Disney. I mean, that's a really difficult thing to do, right? And it beat them. It already today is number one in streaming, so you can just start to make profit from it. It has no nothing holding it back. Think about everyone else in media industry. They have an existing very, very large legacy cable business, which is still producing cash flow for them. They need the cash to survive. So if you try and create a streaming business to transition, right? Ultimately, what you are doing is you are cannibalizing your old business. So they are trying very hard to slowly do it in a very smooth and stable way, right? To ensure that you don't lose the cash flow at the same time you grow this one. You cannot grow this one at the expense of this one, because then you cannibalize all your cash flow, right? Meanwhile, Netflix can just forget about it and just focus on the streaming side. And Netflix also has been trying to poke them, right? Start to change the industry metrics from revenue, from growth to profit, right? Purposely, because he knows that everyone else cannot be profitable now,
Correct.
right? And because streaming is so expensive, everyone else is having a painful time doing it. But I think we can also all agree that something like Disney or even Comcast, right, will eventually do it, Like this is temporary, right? After quite 10 years, just for benefit of doubt, confirm they will also they will transition all the cable guys, customers to streaming, right? At that time, I tell you, Disney will have a massive, massive advantage over Netflix, just because of the IP ownership they have of all the hit franchises.
Nice. Okay. Actually, maybe I just add on my own inputs into Disney. So I've looked at
Yes.
Disney for quite a while, and I own Disney as well. The reason why I own Disney is because I went to Disneyland, and the food there cost 3 times more than the usual meal I have in a Singapore, food court or restaurant setting.
Yeah.
The, even the kids meal there cost like $20, $30. That was like super crazy, and I realized how big of a pricing power Disneyland has for all the people who have kids. When we go there, we have to spend, and that was the turning point, which you know back then I was still quite concerned about their streaming business. Disney Plus is losing to Netflix. I know about the transition, but it is kind of troubling that the things are taking so long to happen. But when I went to Disneyland, I realized that when they have a hit like Frozen, they can make the
Sure.
Frozen park, and everyone has to queue up. Or when I first go into the park at the earlier timing, right, I paid for it. Everyone is rushing into the Frozen ride. And
Yeah,
oh
exactly.
man, that's crazy.
And you know, since I've actually looked into it, let me just add on to what you say, right?
Yeah.
Disneyland has really underrated pricing power, you know, right?
Mm.
So you think about what you just said, right? Everyone rushing to a Frozen ride. How long do you wait? Let me ask you.
You mean for the ride itself?
For the ride,
Uh,
for the Frozen ride.
I waited for 2 hours.
2 hours, okay.
Yeah.
So uh it's already super expensive, right? The ticket, the
Right.
food,
It's
right?
super
And of
expensive.
course, I
Yeah.
think a lot of people will naturally ask, what is the limit of the pricing power? Correct or not? I mean, of
Yeah.
course you can monopolize it, but even monopoly have limit lah, in terms of
Mm.
raising the price, right? I mean, like
Yeah.
Facebook, right?
Yeah.
So I think most people don't realize this pricing power is really unlimited, you know. And what do I mean by that? uh it doesn't mean that Disney can discriminately raise the price and don't do anything, right? The old cable businesses during their heydays, they could do that, but obviously this is not the case, right, for Disneyland.
Mm.
But
Mm.
what Disney can do is they can invest more money into improving the services in Disneyland to raise the price by even more. So let's say
Mm.
per
Yeah.
ticket you want to raise the price, and this is really how they think about it. You know, let's say you want to raise the price of your Disneyland ticket by 20%. Okay, let's say lah. Okay,
Yeah.
what the managers will do is, okay, if obviously if we raise the price of the ticket by 20%, everyone will just riot lah. You know, so we
Yeah.
can't do that. We don't have that level of pricing power lah. But what we
Mm.
can do is we will invest per ticket 10% increase, right? That amount into
Mm.
improving the rides or the experience at Disneyland. How? For instance, we will create a Genie Plus app, right? You use that on your phone, right?
Yeah.
The
Yeah.
Genie Plus app, you will instead of forcing you to wait at the Frozen ride, what we ask you is you buy the Genie Pass premium pass. Instead of waiting physically for the ride, 2 whole hours, you can book your spot, right?
Yeah.
Book your
Yeah.
spot on the app, and then when it's your turn, we will send you a notification. Then you can just go in without waiting. You
Yeah.
see, it massively improves the customer experience of the rides, right?
Yeah.
And for them to add this function in, right, it's just an app. Of course,
Mm.
it's expensive, lah, right? But for Disneyland, it's not, lah, right?
Mm.
So you create an app for all the Disneyland customers. Yes. Does it involve cost? Yes. But they
Mm.
can raise the price as a result by creating more value for the customer. So
Right.
it does involve a bit of cost, but your pricing power is still the extra 10%, correct or not, per ticket.
Yeah. Yeah.
And I tell you, this amount, this ability to improve the service is infinity, you know. It's
Yeah.
really infinity, you know.
Infinity War.
It means their pricing power for the until we die, at least, okay.
Yeah. Right.
It's going to continue.
Yeah.
I'm very, very sure of that. Yeah.
Yeah. Yeah. Thanks
Something that,
for all the sharing on
yeah,
Disney.
sure.
Yeah. So on the other company, yeah, you
Right.
mentioned Meta, right? Yeah.
No, C Limited.
Oh, still limited. Oh, okay. Okay.
Right.
Sorry. Yeah.
Okay, C Limited. Okay, again, I want to clarify, it's not investment advice. Okay, if you buy the stock and it goes down, that's your problem, right? I'm talking about the business. Okay,
Mm.
so C Limited. I think your audience, a lot of them will be familiar. They are the owner of Shopee. Shopee is basically the Amazon of Southeast Asia. Okay,
Mm.
and they made a lot of waves in 2021 when the uh when they did a lot of stuff. I cannot exactly remember that. Okay, but C Limited is no stranger to most people, even in the US, right?
Mm.
And Shopee, right? What you need to know. Okay, first of all, um, they made a lot of mistakes in the past. Okay, but I think for the purpose of this interview, we can skip that because it's already over.
Mm.
Currently, they just turned their first annual profit in history, right?
Mm.
Last year. And
Mm.
I think they will easily do so again. So basically, they are already profitable. And what you need to know about about C Limited as a business is that once they cleared all the previous mistakes of the past few years, right? What happened was that uh, the industry has already consolidated into roughly 5 players. Okay, so the industry here is basically the Southeast Asian e-commerce market.
Mm.
There's Shopee, there's Lazada,
Mm.
there's Tokopedia, right?
Mm.
TikTok Tokopedia, so TikTok Shop
Mm.
and Tokopedia. So Thermo
Mm.
just came in, right? There is and the rest just don't really
Too
matter. Can
small.
you? Yeah. Can you recall anyone else that you use frequently?
Q10 in Singapore is Q10. It's
Q10, right? Q10, correct.
yeah, Q10.
But even Q10 is like less than half the size of Lazada, right?
I think nobody uses them anymore. I don't
Yeah, exactly.
personally
Right?
use them.
So it's the same situation as when I asked you to name, 5 toothpaste brand. Go.
Ah,
Toothpaste,
Colgate lah, Dali. Can't
right?
really recall. Sensodyne.
Right? Okay.
I think that's all.
There's Colgate, right? Most people will know, right?
Yeah, I
And that's
think that's
kind of
all.
it. Kind of
Yeah,
everyone uses like three, and if you really want to see something funny, go to your regular supermarket, okay, like a proper supermarket. Go to the toothpaste aisle. You will see 80% of the thing is Dali and Colgate.
Dali and Colgate, right?
The,
Yeah.
the other 20%, right? Everyone is like stuck there. Okay, so that just shows you, right, the consolidation is just capitalism, like, the rich get richer.
Mm,
In C Limited, it's the same. And why does this happen is because in commoditized industries, it makes sense to consolidate, because the more you consolidate, the lower your unit cost can become, right? You spread your
mm,
fixed cost base across a larger units.
mm,
So in retail, everyone can agree, right? So brick and mortar retail is very, very commoditized. It's no different for e-commerce. Okay, in e-commerce, as long as you have two players, the two players will duke it out to give the best price to the customer. And ultimately, what that means is economy of scale win. E-commerce is just digital retail. It's just the future of retail. There's no
mm,
difference in terms of the business model. Okay, there's
mm,
no mode here at all. But
mm,
what is different about C Limited is the 8,000 pound gorilla in this space. Okay, it
mm,
has 30% traffic share in the entirety of Southeast Asia. Okay, I think it has something like 50% of the industry profits, right? So, um, and I want to make a caveat here. There is one place that Shopee does not have this kind of Indonesia, because Indonesia, as you can imagine, is pretty much the economics is 1970s China, right?
mm,
And there is a huge e-commerce battle still ongoing for the crown between Shopee and Toko TikTok
mm,
lah, right?
mm,
So outside of Indonesia, Shopee has basically won already, right?
mm,
And they are just going to keep on growing their advantage. So I personally just shop purely on Shopee almost. Like
mm,
once in a while, I will just look on Lazada, but their listings are not as competitive, right? This is
mm.
what I mean by it's all purely commoditized. It's the customer who wins at the end of the day.
Correct. Same for
And
me. Uh,
yeah, right,
Last time
yeah,
I used to go Lazada, but nowadays sometimes I cannot find the product I want. I just
yeah,
take
exactly.
Shopee.
No,
Yeah.
to be clear, right, Lazada is still a very legitimate competitor. I know friends who purely use Lazada, right? But
Mm,
at the same time, Shopee has clearly become number one. Is the Walmart of Southeast Asia, because
mm,
as you know, think about 30 years later, right? Everyone is going to be using e-commerce already. Okay,
mm. Yeah.
so Shopee has already created the foundation for that future oligopolistic position. Okay, I
Mm.
call it the Pinduoduo X China, right? Because
Correct.
it is really growing like Pinduoduo. But
Yeah.
if you don't like the China risk involved, right? Shopee just looks exactly like it. The growth profile is pretty much just Pinduoduo, right?
Yeah.
So, and also Shopee's customers also is like Pinduoduo, right? So uh you put all these together, right? The economies of scale, and they are hugely cash flow positive, as well
Mm,
as net cash balance, right?
mm,
So you the balance sheet is really fortress level, right? Because they
mm.
issued shares at the height of the 2021 bubble.
That
They
was
of
a
course they
very
got
small
lucky.
move.
Yeah, I mean, let's be clear, right? They got lucky, right? But at the same
Yeah.
time, they got lucky. They benefit from it now, lah.
Yeah.
So they really own. They have so much cash to just out not just outspend but outlast their competition, right? You just
Mm,
imagine your Lazada now, right? Anything you do, you got to think about what Shopee will retaliate with, since he has so much cash. You don't, right?
mm,
It's like
mm.
a richer guy, like, trying to,
You have to get from your parent, Alibaba.
yeah,
Give me the
right.
money I want to spend.
Can, but Shopee can also get from Tencent, correct or not? You see,
Yeah.
again, it's like really no win, for anyone who is not Shopee outside of
Mm,
Indonesia, lah. Okay,
mm,
so and let's be clear, Indonesia is by far the biggest market in Southeast Asia. So I'm not trying to say that it doesn't matter, lah.
mm.
But it's like 50% they already win already, lah.
Yeah, yeah.
So they have a fortress balance sheet, which means you don't worry about going concern risk, right? They can just like dribble, 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 and let everyone until everyone die, right? And then they are very cash flow positive. So if you look in their reports, right, it's quite easy to be concerned that they have very high investing cash flows, right? Because in their quarterly reports, Limited doesn't go and provide the full breakdown like most companies. They just do a very abridged version. So it's quite
Mm,
easy to see the investing cash flows like bit more than operating cash flows, and get concerned about that lah. But if you
mm,
read the notes, you'll see that all the investing cash flow is really just them reinvesting their uh, investment proceeds, their short-term investments in treasury
mm,
bonds, cash and cash equivalent, right?
mm,
Which means the entire investing cash flow is basically might as well be like negligible, like immaterial lah.
mm, mm,
The capex is not a lot, right? In a digital business, I mean, let's
mm,
be clear, it is a lot. It's still a lot, but not for Shopee, lah, right?
mm,
And operating cash flow is great. Free cash flow is great. So you see, on the balance sheet front, they are smooth sailing. Their cash flow front, they are amazing, right? You just imagine all the other competitors now, including TikTok Shop. The cash flow is significantly negative, operating wise. And
mm.
then on the profit front, they are already like profitable, like first profit.
Profitable.
And I'm sure they are going to window dress this year's profit as well to at
Mm,
least look profitable, right? But at
mm,
least we know that they can be profitable on a sustainable, normalized basis.
mm,
So
mm.
what does this mean? This means that Shopee is the Netflix of this industry, right? Remember what I described Netflix just now? They
Yeah,
already finished the transition. They are profitable. They are cash flow positive while everyone is making the painful transition, right?
yeah,
So similar, right, as Shopee and Lazada. Uh, and also they they are profitable, right?
mm,
Like that is something,
yeah,
of course, our world has become so bizarre that saying a business is profitable is something like, right? That's
mm,
another story lah.
yeah,
But the fact is they are profitable where all the other competitors are not going to be for years to come,
mm,
right? So they really have this huge head start. And unlike Netflix, Shopee doesn't need to worry in 10 years' time Disney is going to come full force with all their IP hit content, There is
mm,
nothing that Lazada and TikTok Shop brings to the table that is different that they cannot do,
mm.
right? Which
Yeah,
means Shopee has win already. As long as they don't do something completely stupid, it's within their control already. They win already, right?
yeah,
So of course, I don't really want to go on the valuation because then it becomes investment advice. But you go and
yeah.
do the valuation yourself based on everything I say. I tell you, wow, I really cannot believe it.
Okay.
Yeah.
On Shopee, right? I mean, on Sea Limited, just a follow-up question from myself. What do you see for the other two segments? So we talk a lot about the e-commerce arm, right? What about the
Yeah.
gaming and the digital payments? So for fintech itself, I do see that it's quite competitive. So like for I myself other than Shopee Pay, right, there are still a lot of other options like Grab Pay Tomi and things like that. So what are your views on these two segments? Yeah.
Okay, so I actually did a free article recently about this, right? Check it out.
Mm.
Maybe you can help me put the floating link here.
Ah,
Okay.
yeah,
So
can.
um okay, so to answer your question, Garena is, I think, it's growing, right? It's still a growth business in the sense that uh how the way most people think about normal growth, but it's not the explosive hyper growth anymore. Okay, so
Mm.
just for some context, Garena got banned. The Free Fire
Free
is
Fire, yeah.
one hit IP. Okay, so our
Mm,
gaming and media is the same exact scenario, right? People gravitate towards one hit content. So
mm,
90% of the profits of the whole industry belong to just a few guys, right? Free Fire
mm,
happens to be one such thing that CMedia owns.
mm,
And Unfortunately, it was banned in India, which is its main user base in 2021, sorry,
Mm,
2022, but it was reinstated in 2023.
mm,
So if you want all the unit economics, go check out my article on my newsletter. Right, I've
mm.
looked at the unit economics, so the QPUs, the QAUs, right, the
Okay.
growth. I would say that Gary, sorry, not Garena, but the digital entertainment in that segment, based mostly on Free Fire, is still growing. And let's be clear, still growing by double digit, right? Still fast, but it's no longer hyper growth anymore. Okay, it's really going to be a cash cow to
Mm,
provide cash to invest into Shopee, the e-commerce
mm,
arm.
mm.
Whereas for the digital
Payments.
payment space, right? Sorry, digital financial services, right? So they
Mm,
just broke it out its own segment last year, right? The first
mm,
time. I've
mm,
looked at their economics, so the segment reporting. I can tell you it's completely still very nascent business, right? It's like it looks like most tech businesses in 2021, right? So of course, I'm not trying to put it down, right?
mm.
They have achieved a lot since years ago,
Yeah.
but it's not enough, lah, right? It's not enough to be competitive. So there's still a lot of competition in this space. I would just write it off as a break even kind of long over the long term, right?
Mm,
I don't really
mm,
think about it. Just pretend they don't have the business because
mm,
there's just too much again, right? Uncertainty, which is
mm.
risk, right? Now you don't know what's going to happen.
Yeah.
So, yeah, I just don't really put a lot of stock into it.
Mm,
If you look at my Excel file, right,
mm.
which you can download on my newsletter, it's like the data that they present, right, is like some years they present this one, some years they present this one, right? Some years missing, right?
Yeah.
So my chart looks like that, tick, tick, and then missing, and then missing. Yeah, yeah.
So basically for C Limited, you just sort of lah, write off the gaming and the digital payment space lah, and then just focus
Yes,
on e-commerce and
correct.
that's enough for you.
Correct. Because if you look at even their revenues by segment, right, which you can
Mm,
find on my newsletter, the chart, the both in terms of absolute revenues as well as percentage of total revenues the e-commerce arm is growing massively, massively, compared to the other two. So you
mm,
can just more or less write off the other two already. It's all purely
mm.
e-commerce going forward.
Yeah. Okay. Thanks a lot for your insights. Wow, very nice to talk about Disney and C Limited. Learn quite a
Right.
lot from you. Okay, now let's move on to something more lighthearted. Right. So my next question is, where else do you park your wealth other than equities?
Right. So if you are my friend, right, you will know that all my wealth is in equities. And the reason is because I don't believe as an economist that house prices will go up, right? So let me just give you a very quick primer, right? House prices have been going up mainly because of household debt to GDP, as well as government debt to GDP. Okay, houses are basically just a toy in the ground. If you remove all the houses in the world, right, and you replace it with factories, right, your country's GDP will double, But what houses do is that they actually act as a multiplier to the economy, right? Because you need everything to build a house. So, as a result, houses are worth it to build for a country, but for the same reason, right? Because it's a multiplier to the economy, there's a lot of incentive for the country to encourage home ownership. And we have reached a point where house prices have already more or less peaked, right? We're talking about real house prices outside of inflation, okay?
Mm, mm,
So of course, with inflation, anything can happen, right? But
mm.
let's talk about
What
real.
about Malaysia, right?
No, you everywhere in the world,
Oh,
China,
everywhere in the
US,
world. Okay,
Canada,
okay.
anywhere that is developed market, including
Oh,
Singapore and Malaysia, right?
mm, mm, mm,
So, um, house prices are really a function of household debt to GDP as well as government debt to GDP. Okay, I don't really want to go into it, but if you look
mm,
at both metrics for most developed countries, they're already at peak already.
mm,
So, um, uh, personally don't believe capital appreciation for houses will be the same as the past 30, 40 years, right? The past 5 years okay, maybe Singapore is different because you all have a unique situation, right? Your house supply is artificial price controlled by the government,
yeah.
okay? But if you look at most other countries, right, house prices have stayed stagnant. Most other developed countries, right?
Mm,
Japan is even gone down. Okay,
Mm.
you can buy a complete house in Japan in a decent part of Tokyo for like 100,000 US dollars, I think,
Mm.
150,000. Okay, so um um so obviously I'm a actual fund manager analyst, right? I actually
Mm.
have the ability to analyze stocks, and
Mm.
stocks, they are not really constrained by other economic factors, right? They are
Mm.
mostly their own business.
Mm.
So unlike houses, right? Obviously there's still the ability for them to repeat their past 40 years of performance, right?
Mm.
Houses really don't. So at least as far as I'm concerned, you can ask any economist, they will
Mm.
probably tell you the same, right? Outside of inflation, house prices will not repeat their performance in developed economies over the past 40 years.
Mm.
And uh, that is why I invest mostly of my wealth in equities.
Equity.
And let me paint a picture of how I started arriving at this conclusion. Right?
Mm.
If you just take a PV of any PV present value of annuity formula, okay, you take if you contribute X amount every year, right, and you grow it at 15% CAGR,
Mm.
keeping in mind that value investing is very risk averse, right? We want that 15% no matter what. So we're not
Mm.
trying to get like 100%, 200%, and then next year lose 50%, right? We are just
Yeah.
trying to get 50% every year, right? And
Mm.
uh, and if you can do that, right, your wealth will multiply by 66 times. Okay.
Mm.
And of course, as you grow older and you get more income, you can adjust the X amount, right? So it's actually more than that. This is just maths. This is nothing like
Mm.
subjective. And this
Mm.
is how the billionaires grow their wealth, right?
Mm.
Billionaires are not super interested in buying Bitcoin and becoming trillionaire. You know what I mean? They already own their wealth, right? What they want
Yeah.
to do is, okay, I don't want to put it into a treasury bond, where I only earn 5%. I want to earn
Mm.
15%, right? Or
Mm.
at least 12%, right? Then
Yeah.
I can grow my wealth and then I can pass it on to my children for the next 3 generations, that kind of thing,
Yeah.
right?
Yeah.
And I want to do it in a very safe way. Yes, I
Mm.
want to earn 50%, but I want to guarantee I do it. I don't want to lose money, right? Warren Buffett's rule number one, correct?
Yeah.
So it's the same concept, right? You just exploit the math of compounding, grow your wealth, right? More or less, if you start early enough, right, you can achieve whatever realistic goal that you set out, right? And I
Mm.
can tell you, it is almost guaranteed to do better than buying a house, right? Because keep in mind again, value investing is very, very risk averse. Okay, going back to what Benjamin Graham's definition of it, investment operation is where you guarantee the safety of your principal
Mm.
and get an adequate return. So if you're
Mm.
earning 15% guaranteed with zero loss, right? At least as far as you are able to assure yourself of,
Mm.
that fits that profile. You are basically buying a 15% bond. You know what I mean?
Mm.
And if you think about it in terms of 15% bond, right, I tell you, I think most people can agree the math works out. It's just math.
Mm. Mm.
This is
Thanks.
how
Thanks.
billionaires get each other. Yeah.
Yeah. Thanks for the insights on how to park the money. So, other than this, right? I mean, do you also keep like a spare amount? Like, for example, when you want to invest, right? You don't want to invest 100% into equities. Do you keep some spare cash and then invest when the opportunity comes about?
Oh,
Yeah.
I mean, the answer is yes. The spare cash is just my non-portfolio money.
Okay.
I mean, obviously,
Yeah.
I don't invest my entire net worth, right? I need money
Mm.
to eat, right? Yeah. So when I see something that is opportunistic, then I will consider using some of the money to invest. But at the same
Mm.
time, the way I tend to think about this question is really
Mm.
more in terms of opportunity cost. Remember what I was saying? Value investing is about ROIC, opportunity cost, and asymmetric risk reward, right?
Mm.
So, sorry, risk, right?
Mm.
So, um, the opportunity cost here is framed as earnings yield, right? And in
Mm.
fact, if you look at a DCF formula, how do you normally treat your cost of equity in the WACC calculation? You are taking the index, right? The long-term returns
Mm.
of your preferred index, so SPX,
Mm.
whatever. And
Mm.
what you are basically saying is, when you do that, is that if I invest in this stock that I'm doing the DCF on, I cannot take it and invest in SPX, right? That's why it's opportunity cost. It's like an IRR of the against the SPX, right? That's why you put it in your cost equity calculation in your WACC, your WACC discount rate. So it's the same concept, right? When I want to buy a stock now, right? Okay. And then of course what the cost of equity in that case is normally the earnings yield of the S&P, right? Or something equivalent, right? When I want to invest in, let's say, stock A, right? And I want to sell stock B in order to fund stock A. What's the formula for that? It's just the earnings yield, right? I want to buy again. I told you from the start that value investors treat stocks as bonds, right? So we think about it in terms of yield. When I want to buy stock A, what am I buying? I'm buying the yield, right? I'm paying this amount of capital to get this kind of profit. That's the yield of it, right? What is my opportunity cost when I sell stock B to do that? It's just the earnings yield of stock B, right? And it's not the earnings yield that I get today, like today's earnings yield. It's the earnings yield when I bought stock B, right? Because that is my actual earnings yield up to today. If stock A's earnings yield is better than yesterday's stock B's earnings yield, then it's worth doing it, because now I'm getting a higher earnings yield. Ultimately, I don't care about stock market. I only care about the capital and the yield. So that is how I frame a decision. Even if you don't talk about like taking your outside cash to put in the portfolio, right? You can recycle your yields, and more or less, if you are really truly a value investor and you're only buying like 1 or 2 stocks a year, right? You more or less will always have some sort of other stock which has a poorer earnings yield to cycle capital from. Yeah.
Thanks for the sharing. Okay, next question. Do you have any go-to investing tools to do all your research and company analysis, or even follow up on the market news?
I mean, honestly, the one I use the most is just TIKR, ticker.com, right? So ticker.com is a financial screener. Basically, it uses Morningstar data to provide global stocks, right? And if you, as a value investor, a long-term investor, you don't really need more than public information to outperform the market, right? You really don't, because think about it, even the CEO doesn't know what's going to happen 5 years out, right? What's the point of getting management commentary? There's no advantage when the CEO himself don't know anything, right? So you really don't need more than that. I think what Ticker really does is help me screen very fast. So let's say I hear interesting stock from someone else, I will just go to Ticker and check out the cash flows. Like I recently did it for a few stocks, right? So like some people were just commenting it. I didn't really want to put in all the effort to like open the financial report, download it, do the Excel file, right? So I just go on Ticker and just click. Is it worth my time further to look further into it, to do a proper Excel model, right? And the answer to that was no, for that particular stock. So,
Nice.
but I use it all the time. Yeah.
Thanks for the tool. So it's ticker.com. Okay.
Yes.
The last question that we have. All right. So what advice would you give to the readers or to your younger self if you were to, start up again in investing?
It's very simple. So keep in mind, I'm coming from a value investing perspective, right? It is just to listen to anything Buffett, all the legendary value investors I heard of before, right? Buffett, Howard Marks, Benjamin Graham, Seth Klarman, all these guys, right? Whatever they say, just listen to them at face value and ignore your own intuition, because they are smarter than you. It's really as simple as that, right? If I had done that, right, my wealth would have doubled already by now, right? And what do I mean by this, right? I used to use an example. Think about if your mother tell you as a child, right, when you were like 3 years old, okay, don't touch this fire, right? The mother tell you, of course, now we know the fire is hot, right? But when you were 3 years old, you didn't know, correct? Okay, let's say 5-year-old, okay, at least you know what is fire, right? When you were 5-year-old, you didn't know whether your mother is correct or not, right? So you have 2 options. One is you listen to your mom, even though you yourself see the fire so attractive, right? And you want to go and touch it, right? If you had listened, you go against your own 5-year-old intuition, you will save yourself from getting burned, right?
Yeah.
And then later on, when you become 8-year-old and you know that fire is hot, then at least good thing I listened to my mom, right? Whereas if you are the 5-year-old who is so adventurous, and then you listen to your own intuition, right? Your intuition tell you fire is pretty, so beautiful, right?
Go and touch
But you
it.
don't know the fire is hot. You go and touch it, then you get burned. Then you learn the hard way. Then your mother will come and tell you, I told you so, right? Right?
Yeah.
Or worst case scenario is you burn your hand off, right?
Yeah.
So that's the same experience for a lot of investors when they start out in the stock market, right? They follow their own intuition. And I want to clarify that I don't mean it in a judgmental way, because I know more than anyone else how difficult it is to fight your emotion, right?
Mm.
When you know your net worth is at stake, when
Mm.
you see you have the FOMO because all your
Yeah.
friends are making money on Bitcoin, right? I don't want to reduce it because I know how difficult it is. But at the same time, if you're just asking me about what is the right thing to do, right? It's really just listen to your mom, your value investing mom, which is Warren Buffett, right? So what do I mean by that? Let's say Warren Buffett say, what's Warren Buffett's most famous rule? Can you tell us?
Don't lose money.
Yeah, rule number one, never lose money. Rule
Rule
number
number
two,
two, follow
don't forget
rule number
rule number one, right?
one.
So
Yeah.
it's quite natural for most people to hear this advice and think, what are you talking about?
I just,
Because
a bunch
you
of.
never lose money, okay, I guess go and park it in cash and forget about it, right? Right?
Mm.
But
Yeah.
obviously, we know that Buffett means it in a very stock advice kind of situation,
Centric kind of advice.
right? And the thing is this, where he's coming from is really much higher level. There's a lot of context, and if you really want to know all this context, I wrote long essays about it on my newsletter. Go read it up. It's all free because it's just value investing philosophy, right?
Mm.
Go and read it up. And if you truly understand this, right, you will recognize that the problem about Warren Buffett's advice, right, is not the advice itself, but it's really about you. You don't have the investment wisdom and decades of experience to understand what he means. And if, like I said, if you really want to understand, go to my newsletter, right? But
Mm.
what Warren Buffett can really crystallize in a bite-sized way that can be communicated to everybody is just do the right thing, right? I give it
Mm.
to you, you follow the advice, then you go and find out yourself what I actually meant by it, right?
Mm.
It's not just take the don't lose money and stop there and then okay lah, go and buy in cash. You know what I mean? That's not what he means,
Yeah.
right?
Yeah.
So
Yeah.
it's not just Warren Buffett, it's all the other guys as well. Like Graham also
Mm.
has his saying, definition of investment operation is one which guarantees the safety of principal and an adequate
Mm.
return. What he's
Mm.
saying is treat your stock as a bond, right? Not
Mm.
you need to
Yeah.
make sure you don't lose your money when you invest. It's not just about maximizing your capital. Maximizing your
Mm.
capital appreciation, right?
Mm.
Think about 90% of stock market participants. Stocks is about investing, about capital appreciation and maximum risk, right? Like a small business kind of approach, correct? Like they
Yeah.
go and distort what Buffett say about stocks not being pieces of paper but pieces of business to say, you go and treat your stock investment like a business. Just throw it
Mm.
there and hope for the best, right? And then do whatever it takes. When you're in a business, you can do that because you have quite a few things in your control. When you
Mm.
are in the stock market, you can have two things in your control. You can click buy, you can click sell. That's it. You pray to whatever God, right? The stock market price go down, it's not going to go back up, man. Right?
Yeah.
So you cannot apply that same logic to stock investments. You really need to treat it like a bond, right?
Mm.
And of course, it will at first glance, right? You probably, if I didn't tell you this, you would not know that's what Benjamin Graham meant, right?
Mm.
Safety of principal adequate return equals to bond. So you need
Mm.
to give yourself that time, right? Since yes, your mother is there, but your mother is already divorced, and she went to some other stepfather, right? And now you only have her advice that she write in her diary, right?
Mm.
Like Warren Buffett is not going to come to wherever you are and explain to you everything, right?
Yeah.
You got to learn it all yourself. But as long
Mm.
as you follow the advice in your mother's diary, right, you will be okay. And when
Mm.
you are 8 years old one day, you are going to learn it, and you're going to look back and you're going to say, like me now, ayo, why didn't I listen to him? I
Mm.
make so many mistakes in my investing career, right? I have reached a
Mm.
point where I just lost faith in myself. Anything
Oh.
where what they say is contradict to what I say, right? I
Yeah.
will listen to them already because I have just
Oh.
lost too much money, that painful experience, right? To put my own regard above them already.
Wow.
And
You touch too
here's the
much
thing.
fire already.
No, everything they say has turned out to be correct. Like it's
Mm.
one thing if you are just talking experience, say this with experience, everything that they have said, right, has turned out to be correct. And that is how value investors are born, right?
Mm.
Because you learn from painful mistake, right? And then you reflect back, oh, if I had just followed them, I would not have made this painful mistake. And then over time and experience, right, you just naturally realize they have been right all along. So the next time that you think you're right, why not just try and trust them for a while? It's not like it's gonna matter, right?
Yeah,
Right.
okay. Thanks a
Yeah.
lot for the sharing. I mean, very nice analogy there on touching the fire because of your intuition, lah. And
Right,
instead
right.
you can listen to the gurus like Warren Buffett and all that. Okay.
Yeah, you're very
So
interesting vibes, right?
yeah, thanks. So okay, so that's all the time we have for today's podcast. A huge thank you to Aaron, our amazing guest, for sharing such valuable insights to us, and we
Mm.
greatly appreciate you being here.
Yeah, no worries. Thanks, James, for
Yeah.
having me. I really appreciate it.
Yeah, thanks. I will put all your links down in the description box below, lah, so the readers can follow and go to your newsletter when they read this YouTube channel. All right.
Right.
Okay. So for all our readers, if you enjoy this kind of conversation and want to see more of these, please make sure to help us like the video, hit the subscribe button, and ring the bell. Once again, thank you everyone for watching, and I will see you in the next episode. Thank you,
Uh,
Aaron.
right.
Thanks.
Please visit my newsletter,
Yeah.
valueinvesting.substack.com.
Okay. Can. I'll put the link down below. Thanks.
All
Thanks a
right. Thank
lot.
you.
Bye-bye.
Bye.
Bye. Before we end off, if you find the video helpful, I would appreciate it if you can help me to tap the like button and share the video so more people get to know about this video. Next up, don't forget to check out this video over here if you have another few minutes to spare. And I will see you next time. Thanks for watching and ciao.